Welcome to the introduction to the statement of cash flows. This is a video based on the theoretical concepts of IAS 7. This is also part of a series of videos that will discuss in detail the theoretical and practical perspectives of cash flow preparation. You are watching Accounting Zero to Hero. The videos in this series will be shown in the following structure. First, we discuss the theoretical basis of the cash flow preparation, and then we move on to the practical applications. This is further split into two, the indirect method and the direct methods. To give you more options on how to prepare the cash flows, each methods are further divided into two. The traditional indirect method, the indirect method using cash flow worksheet, the manual direct method, and lastly, the direct method using the cash flow worksheet. In this diagram, this video discusses this portion right here about the theoretical concepts. The objectives of IAS 7 is to require entities to provide information about historical changes in cash and cash equivalents. We normally do it in a separate financial statement which classifies cash flows during the period from operating, investing, and financing activities. This separate financial statement is what we call the statement of cash flow. The preparation of the cash flow statement has no exemption under IFRS, since it is one of the main financial statements. This means that the provision of IAS 7 applies to all entities, regardless of its size, operations, ownership structure, or industry. So what are we going to learn today? First, we're going to tackle what are cash and cash equivalents. What is a restricted cash and what are its implications? And lastly, and most importantly, the classifications in the statement of cash flows as to operating, investing, and financing activity. This video is intended to be the theoretical portion of the cash flow training, where we will learn the definitions and general discussions before we go into the nitty-gritty of the actual cash flow preparation. So what are cash and cash equivalents? First, let's discuss cash. Simply, cash comprises the actual cash on hand and demand deposits. However, the definition of cash equivalents are a little bit more complicated. Cash equivalents, according to the standard, are short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. For investments to qualify as cash equivalent, they must be number 1, short-term, number 2, highly liquid, number 3, readily convertible into known amounts of cash, and lastly, they are subject to insignificant risk of changes in value. As you can see, the definition of cash is fairly simple. The actual cash that you have on hand and the demand deposits that you have with the bank. However, cash equivalents have specific definitions according to the standard. The statement of cash flows excludes movements between cash on hand and cash equivalents because these are components of an entity's cash management rather than part of its operating, investing, and financing activity. It is important to understand the entity's cash management policies, especially when considering whether balances that are not obviously cash on hand and demand deposits should be classified as cash equivalent. IAS 7 states that cash equivalents are those that are held only for short-term cash commitments rather than for investment purposes. The standard generally considers a maturity date of 3 months or less from the date of acquisition to be considered short-term. In summary, apart from the cash on hand and the demand deposits, which are treated as cash, if a company has investments that has the following characteristics of being short-term, highly liquid, readily convertible into known amounts of cash, and subject to insignificant risk of changes in value, then the particular investments should be classified as cash and cash equivalents and should be included in the statement of cash flows. What about restricted cash? IAS 7 states that the amount of a significant cash and cash equivalent balances that is not available for use by the group should be disclosed, together with a commentary by management to explain the circumstances of the restriction. Examples provided by the standard include cash and cash equivalent held by a subsidiary operating under exchange controls, or other legal restrictions that prevent their general use by the parent or other subsidiaries. There should also be an assessment of the nature of the restriction to check if the amount is not anymore eligible to be classified as cash and cash equivalent. This can happen if, for example, the investment is not anymore highly liquid or easily convertible. For example, an entity may be required to formally set up an escrow account as part of a specific transaction or project. The nature of the restriction of access to the escrow account should be individually assessed to determine if it can still fall under cash equivalent. If, for example, that the company is restricted from accessing the escrow account for day-to-day operations, it might be more appropriate to classify this escrow account as other financial asset, which are normally in other receivables in the balance sheet, rather than being included in the cash flow statement as part of your cash. The classification of cash flow movements. The standard requires the statement of cash flows to report inflows and outflows of cash and cash equivalents to be classified into three types: operating activities, investing activities, and financing activities. The cash flows are classified into each type in a manner that is most appropriate to the entity's business. For example, purchase of a piece of land may be an investing activity for a manufacturer because they are not involved in the buy and sell of real estate properties. However, it can be an operating activity for real estate dealers. Now let us look into each of the type one by one. Cash flows from operating activities are the inflows and outflows from the principal, revenue-producing activities of the entity, and other activities that are not investing or financing activities. The standard states that the value of the information on operating cash flows is twofold. Number one, it provides a key indicator of the extent to which the entity has generated sufficient cash from its operations to pay debt, pay dividends, and make investments to maintain and increase its operating capability without recourse to external sources of financing. And number two, it provides information about the components of historical operating cash flows that assists in the process of forecasting future operations when used in conjunction with other financial statement information. Examples provided by the standard include the following: cash receipts from the sale of goods and the rendering of services, cash receipts from royalties, fees, commission, and other revenue, cash payments to suppliers for goods and services, cash payments to and on behalf of employees, cash receipts and cash payments of an insurance entity for premiums and claims, annuities, and other policy benefits, cash payments or refunds of income taxes unless they can be specifically identified with financing and investing activities. And lastly, cash receipts and payments from contracts held for dealing or trading purposes. This section is also a default category for any cash flow that do not meet the criteria of investing and financing cash flows. The key idea here is the assessment of the principal revenue-producing activities of the entity. If the cash flow is coming from these principal revenue-producing activities, then it should be classified as operating cash flow. However, IAS 7 states that this section is also a default category for any cash flow that do not meet the criteria of investing and financing cash flow. One example provided by the standard are the acquisition-related costs in a business combination that have to be recognized as an expense under IFRS 3. These are classified as operating cash flows because there is no related asset that would justify classification as an investing cash flow. Cash flows from operating activities may be reported on a gross or net cash basis, also known as the direct and indirect method. Under the direct method, major classes of gross cash receipts and gross cash payments are disclosed. The standard encourages the use of the direct method because it provides information which may be useful for estimating future cash flows. Under the direct method, the major classes of gross cash receipts and gross cash payments may be obtained from: number 1, the accounting records of the entity, for example by analyzing the cash book or the bank statements. Number 2, by adjusting sales, cost of sales, and other items recognized in profit or loss for changes during the period in inventories and operating receivables and payables, other non-cash items, and other items for which the cash effects are investing or financing cash flows. You will see that these two methods will be discussed in the practical applications later. The first one would be the manual direct method, and the second one would be the direct method using the cash flow worksheet. Below shows an example of a cash flow statement prepared using the direct method. You will see that the operating activities in the example is consistent with what we discussed. It shows gross cash receipts and gross cash payments in the operating activities section. It is quite challenging to find a publicly traded company that uses the direct method, so here is just the pro forma from the standard. In the net cash from operating activities, you will see gross cash movements from customers, payments to suppliers, cash paid to employees, and other items. The standard encourages the use of the direct method because it is easier to understand. The indirect method arrives at the same value for net cash flows from operating activities, but does so by working back from amounts reported in the Statement of Comprehensive Income. The most common way of preparing cash flows under the indirect method adjusts the reported profit or loss for the effects of changes in inventories and operating receivables and payables during the period, non-cash items such as depreciation, provisions, deferred taxes, unrealized foreign currency gains and losses, and undistributed profits of associates, and all other items for which the cash effects are investing or financing cash flows. All of these definitions may be a little bit overwhelming, but we will discuss this in detail in the practical application, especially on the preparation of indirect method cash flows using the cash flow worksheet. According to IAS 7, when an adjusted profit approach is used under the indirect method, the reconciliation should start either with profit or loss before tax or profit or loss after tax. Both are acceptable. Any other basis such as EBITDA, EBIT, or profit or loss excluding NCI does not meet the requirements of the standard. I'm going to show you an example of a cash flow statement prepared using the indirect method. Presented here is an example of a statement of cash flows using the indirect method, specifically for Apple Incorporated. This is for 3 months ended December 25, 2021, which means that this is for the period of October, November, and December of 2021. You will see in this example that it is consistent with the previous process that we discussed for the indirect method. We start with the net income, or the profit after taxes, and we adjust them for the changes in inventories and operating receivables and payables during the period. We also adjust them for non-cash items such as depreciation, provisions for deferred income tax expense or benefit, and also share-based compensation expense, and also for all other items for which the cash effects are investing or financing cash flows. It is important to note that the direct and the indirect method will show the same net amount of cash flows from operating activities, but will have different ways of presenting them. One of the reasons IAS 7 prefers the direct method is because it provides an easier way to forecast future cash flows, if you can see the periodic growth of the gross cash receipts and gross cash payments, compared to the overall information we have in the indirect method. In practice, The indirect method is more commonly being used because it is easier to prepare. We will look into the actual preparation in the subsequent videos of this series. We now move on to the investing activities. Cash flows from investing activities are defined as the acquisition and disposal of long-term assets and other investments not included in cash equivalents. This category of cash flows allows users of financial statements to understand what activities were undertaken related to the resources intended to generate future income and cash flows. Cash flows from investing activities include the following under the standard: payments to acquire and receipts from the sale of property, plant and equipment, intangibles, and other long-term assets. Payments to acquire and receipts from the sale of equity or debt instruments of other entities and interests in jointly controlled entities. Advances and loans made to and repaid by other parties, other than advances and loans made by a financial institution. And payments for and receipts from futures contract, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or if the cash flows are classified as financing activities. Cash flows from investing activities only include expenditures that result in the recognized asset in the statement of financial position. This means that payments arising from the exploration and evaluation activities and for research and development that are recognized as an asset are classified as investing cash flows, while entities that recognize such expenditures as an expense would classify the related payments as operating cash flows instead. Major classes of gross cash receipts and gross cash payments arising from investing activities should be reported separately, except for those items that can be reported on a net basis. We will discuss about this net basis of presentation later. Going into the same example from the operating activities section, we will also discuss the Apple Incorporated investing activities section of their statement of cash flows. As you can see, in the condensed consolidated statement of cash flows of Apple for the 3 months ended December 25, 2021, again, this means that this is the cash flow from Apple for the period October, November, and December of the year 2021. The first portion is the operating activities, which we have already discussed earlier. If you scroll down below, you will see the investing activities. By looking into the investing activities section of the statement of cash flows of Apple Incorporated, you will see that it is consistent with the definitions of the standard. They have expended $34 billion for the purchase of marketable securities, which are recognized asset or investments in the balance sheet of Apple. You will also see that they have collected $11 billion from the proceeds of the maturities of the same marketable securities, and they have collected as well $10.6 billion from the proceeds of sales of marketable securities. They have also paid for the acquisition of PPE or property, plant, and equipment amounting to $2.8 billion. This leads to a total cash used in investing activities of $16.1 billion. We now come to the last type of cash flow movement, the financing activities. Cash flows from financing activities include the following according to the standard: proceeds from issuing shares or other equity instruments, payments to owners to acquire or redeem the entity's shares, we call this treasury shares, proceeds from issuing and outflows to repay, debentures, loans, notes, bonds, mortgages, and other short or long-term borrowings, and payments by a lessee for the reduction of the outstanding liability relating to a lease. You will notice that financing activities include mainly movements on the equity section of the balance sheet, such as the shares, and the long-term liabilities of the balance sheet, such as borrowings from financial institutions, loans, notes, or bonds. In the consolidated financial statements, financing cash flows will include those arising from changes in ownership interests in a subsidiary that do not result in a loss of control. Major classes of gross cash receipts and gross cash payments arising from financing activities should be reported separately, except for those items that can be reported on a net basis. We will discuss about this net basis of presentation in the following slides. Going back into the statement of cash flows of Apple Incorporated for the period of the 3 months ended December 25, 2021, or for October, November, and December of 2021, you will see that the financing activities are directly below the investing activities. Consistent to what we have discussed related to the cash flows from financing activities. The ones from Apple include those that are related to equity, such as the first three: payment for taxes related to the net share settlement of equity awards, payment for dividends and dividend equivalents, and repurchases of common stock. It also includes the repayments of the term debt, or as what the standard has said, proceeds from issuing and outflows to repay debentures, loans, notes, bonds, mortgages, and other short or long-term borrowings. It also included proceeds from or repayments of commercial papers. This results to a net cash used in financing activities of $28.1 billion. This means that during the 3-month period of October, November, December of 2021, the total amount that Apple has paid for activities that are related to financing are $28.1 billion. As a summary, you will see that the net amount of operating activity cash flows of Apple is $46.9 billion. A positive amount means that they have generated cash from their operations amounting to $46.9 billion. The investing activities section shows that out of the cash that they have generated, they have spent $16.1 billion related to investing activities, which are purchases and proceeds of marketable securities, payments related to the acquisition of PPE, etc. And lastly, they also paid $28.1 billion related to the financing activities for the repayment of long-term debt, for the proceeds from commercial papers, and for dividends, etc. If you get the total of this $46.9, negative $16.1, and negative $28.1 billion, you will see that for the 3-month period, they have increased their cash and cash equivalents and restricted cash by $2.7 billion. So that is the summary of the statement of cash flows, or at least how to interpret the different lines that you will see here. So what do we mean by presentation on a net basis? In general, major classes of gross cash receipts and gross cash payments should be reported separately. Operating, investing, and financing cash flows can be reported on a net basis if they arise from cash flows that reflect the activities of customers rather than those of the entity and are thereby made on behalf of customers. An example of this include acceptance and repayment of demand deposits by a bank, funds held for customers by an investment company, and rents collected on behalf of and paid over to owners of properties. The second example provided by the standard are cash flows that relate to items in which the turnover is quick, the amounts are large, and the maturities are short. Examples of this include advances made for and the repayment of principal amounts related to credit card customers, the purchase and sale of investments, and other short-term borrowings such as those with a maturity on drawdown of 3 months or less. As the last part of this video, we will discuss specific classification issues. IAS 7 provides guidance for the classification of specific items. An entity is required to disclose separately cash flows from interests and dividends received and paid, and their classification as either operating, investing, or financing activities should be consistent from period to period. Interest received can be operating or investing activities. Interest paid can be operating or financing activities. Dividends received can be operating or investing activities. Dividends paid can be operating or financing activities. Taxes on income. Cash flows arising from taxes on income should be separately disclosed within operating cash flows, unless they can be specifically identified with investing or financing activities. However, in practice, this is normally difficult to apportion, so tax payments are normally classified singularly as operating activities. And lastly, treasury shares. Payments related to treasury shares are recognized as equity transactions. Hence, these qualify as financing activities. Let us now summarize what we discussed so far. First, we looked into what composes the term cash and cash equivalents. We mentioned that cash commonly comprises of cash on hand and demand deposits, while cash equivalents are short-term, highly liquid investments that are readily convertible into known amounts of cash and has insignificant risks of changes in value. In addition, we also discussed what happens if there are some restrictions in the use of the company's cash. We may disclose these restrictions, but we need to investigate further if these are limitations on the availability of the funds, in which case we classify them into other financial assets away from the cash balance. Secondly, we discussed the classifications of cash flows. They can be operating, investing, or financing activities, and we looked into what types of cash flows fall into each of them. In the next video, we will get our hands dirty and discuss how to prepare the statement of cash flows in different ways, so you wouldn't want to miss that. Make sure to subscribe and hit the notification bell to keep yourself updated on the channel. See you!